I wanted to welcome everybody here tonight. My name is Leslie Rand. For those of you that don't know me, I'm the Fund Development Manager here at the Alzheimer's Society. And I woke up this morning with this rash that's almost like hives on the side of my face, and I think it's because we're going to talk about taxes tonight. I'm pretty sure. I'd also just like to point out there's a couple of my colleagues here that are on part of our social work team, Brooke Hurley and Britton Williams, that may participate in the discussion when we get to the Q&A piece. I know a lot of you in the room tonight are very familiar with the services of the Alzheimer's Society, social work counseling, support groups, learning series, social recreation programs, but we also are here to educate, and tonight is part of our public education speaker series. We offer that several times a year. It's open to everyone. So thanks to all of you for joining us here tonight for this one. We're proud to present the topic of financial confidence. You might be thinking, why is the Alzheimer's Society doing a presentation on finances? There's a few reasons for that. First off, many families living with dementia, as you all know, there's so much energy that gets expended in just the day-to-day activities of living that thinking about your finances might be fairly low on the to-do list. Secondly, with dementia, we also can see the downside of what can happen when capacity issues arise and plans haven't been put in place that consider things like powers of attorney, long-term care costs, asset transfers, and the other financial considerations. So tonight's presentation is going to really focus on some of these issues, and I hope we'll all get some great insights into that. And all of these elements are part of an overall estate plan. As a lot of you know, the Alzheimer's Society is a nonprofit charitable organization that relies on the community we support to provide the programs and services that we do. So we are not going to talk about estate planning here tonight. So now I just want to introduce our speakers for tonight. They are both with IG Wealth Management here in the London area. And IG Wealth Management has become a really important partner for the Alzheimer's Societies across the country as the national presenting sponsor of our Walk for Alzheimer's. And certainly the team here in London has been incredibly supportive of our walk, which is going to be May 9th, 2020. We're really grateful for that growing partnership. So Derek Del-Bel-Baluz and Tim Grant are both regional directors at IG Wealth Management. So without further ado, I want to turn it over to them to help us all build a little bit of financial confidence.
Good evening, everyone. We want to put everyone at ease. Derek and I look after the offices. We're very highly qualified to answer the questions that you have. But that being said, Derek and myself, we don't have clients. So tonight we're unbiased up here providing you some information that not only you might find valuable, but maybe someone else that you know might be able to find valuable with that as well. If you have questions, please ask. So tonight we're going to talk a little bit about what we do here with IG Wealth, our support with the walk. It's been a great part for us here in London and surrounding area to be part of it. I know this year we're very excited to get out there and support that. One of the largest fundraisers, as Leslie said. Over 5 million IG and Alzheimer's raises across Canada. So it's not just a London function, it's something that we do from coast to coast. IG Empower Your Tomorrow, financial confidence workshops. What we specialize in is financial planning, spending time with families, taking a look at their present situation and being able to provide advice. Projections of how your situation will go as you move forward throughout time. Covers many areas: income, expenses, liabilities and debts. Income taxes. I know Leslie talked about sweating about some income taxes. That's probably a common theme as we move forward here. Retirement planning, estate planning, and something that comes quite often in our planning situations is insurance. So we'll talk a little bit about that as well. What does a financial plan accomplish for you? When I'm out seeing clients and working with consultants, it's like a GPS. It takes you from point A to point P. I don't think my family likes to drive to Florida. I don't think I jump in the car and start heading south and hope to get there. We, in the good old days, follow a map. Today we follow a GPS. That's what a written financial plan provides for you. Measures actual performance against your goals. So at least you have a base zero to take a look at, so that way you know where you're going. Allows you to track your progress towards your goals. Each and every year, my wife and I sit down, we track out what we want to achieve in the next year, and then at least we can take small steps towards achieving that. And in this, a written financial plan can help you to do that. Identifies areas for adjustment. Like a GPS, if there's an accident, like there was today, how do you function and get around that to still reach your goal? If you don't have it written down, it can become very difficult. We're going to talk about the tax system and the 3 pillars of retirement and what we're looking at. So the 3 pillars in Canada: government administration and administered benefits, employment-based savings plans, as well as personal savings. Government administered benefits. So things like Canadian Pension Plan. Some of these things may be repetitive for you, you may know about. Others may be something that's new to you. Old age security, things like the guaranteed income supplement, allowance for spouse and common law partner, and allowance for survivor. Employment-based savings plans, things like registered pension plans, group RSPs, as well as other employment-sponsored plans. So throughout those, they form a very important part of your written financial plan, mixed in with your personal savings, whether it's registered retirement savings plans or RRIFs, tax-free savings accounts like TFSAs, and non-registered investments as well. I want to talk a little bit about government-administered benefits. Again, how do I access OAS? That's a common question that's out there. Is it something that I have to do? Does the government do it for me? Do I just automatically qualify? An automatic enrollment letter should be sent after turning age 64, notifying you whether you qualify and your pension starts at age 65. In some cases, you may have to apply to the Service Canada to be able to do that, whether online or in a paper version. In some cases, you may want to take advantage and defer receiving this OAS payment until age 65 to as late as age 70. It's a question that comes up quite often. And what we take a look at is who gets this? Who gets the GIS supplement as well? First, you must receive the OAS, so you have to qualify for that. Your annual income must be below a certain threshold. In most cases, you'll be automatically receive the GIS if you are eligible. So it's something that you're not applying for, you'll receive it through the OAS. In some cases, you may need to apply through Service Canada, though, to be able to still receive it. When can I receive CPP? Okay, this is always a question that we get, and it's an important one for planning because you can take it early or you can defer to take it later. Many people decide to take CPP at age 65. However, CPP can be taken as early as age 60. Okay? There is a slight reduction each month for each month that you do take it before age 65. And if you do decide to defer it, you can defer it to age 70, and there is a slight increase each month on that payment as well. Sitting down with a written financial planner to create a written financial plan for you, they can provide that advice on what may be best for you. Each individual person is unique, so I wouldn't take advice without being able to sit down with a professional to take a look at that. How do I access my CPP? That's a question that comes up to us quite often. No notification from Service Canada to start CPP. Okay? No automatic enrollment for CPP except at age 70. So you need to apply. Otherwise, you must apply to Service Canada to receive CPP. I keep referring back to Service Canada. It's something that you can do by going online to be able to do it, and there's paper forms as well that you can use through Service Canada My Canada account. Paper applications may be required in some cases. How do I decide? Authorize a trusted person to communicate with Service Canada to gather the information. In these cases, if you don't feel or you haven't been capable of being able to ask the right questions or know where to turn, you can have someone designated as your authorized trusted person to be able to do it, to be able to gather the information, to be able to get someone to provide you with advice. Consider using an experienced accountant or financial planner to review your situation and provide the advice you require to make that decision properly. For seniors who have lost capacity, a third-party administrator may be appointed to apply the benefits on behalf of that senior. In most cases, we would make the recommendation that whether it's a trusted family member, a professional that you've used, an accountant, or a trusted financial planner, before I would authorize someone else to do it. The disability tax credit. Okay. This is something it's a little bit of a misnomer for many individuals, something they didn't know about. It's come about over some time here. How do you apply for it has always been a big thing. Do I just qualify, or I'm not going to qualify at all without getting the right medical information? So we'll talk a little bit about this. Claim on the personal income tax return, this credit. Federal non-refundable tax credit. Right now, presently in 2019, I know we just had an election and these things can change, but it's $8,400, okay, that's on there. Provincial non-refundable tax credit amount varies by province. We're only going to talk about Ontario here, but of course this presentation is across Canada. The disability tax credit available when individual has severe and prolonged impairment in mental or physical functions. I can speak from personal experience. My father's disabled. It took quite a while for us to be able to get this put through and applying to medical practitioners, which I'll talk about. But to this day, once you've applied, you have it, and then it renews, and you have to continue to go back. CRA approval of the disability tax credit opens doors to other credits and programs, including the RDSP. How do I apply for the disability tax credit? The disability tax credit must be applied for using Form T2201, okay, and approved by Canada Revenue Agency. So once it's completed, it's submitted to the Revenue Agency. They will then approve that. First page of the form requires basic contact information, items that you'll be able to fill out. The remainder of the form requires the patient's medical practitioner to complete. So it needs to go into your family doctor or specialist that you're using at that time to complete, so that way it can be submitted and sent back to CRA. Should I use a service? There is services out there that will charge a fee for you to be able to complete these forms. I want to talk a little bit about that today. Some businesses offer to obtain the disability tax credit approval from CRA on behalf of the client. Often they will charge a percentage of the tax refund, which can be substantial. Remember, most of the work that can be done by the patient's doctor, and they often charge a small fee. Even when the disability can be hard to prove, as I mentioned about my father, a tax accountant can help advise the doctor for a flat fee instead. Quite often I would do a little bit of research on this one by talking to a licensed professional to be able to provide you the advice before going out there and just taking anything that's offered. The costs can be quite substantial. Attendant care and tax credits. Attendant care expenses. Fees paid for private home care. Nursing expenses. Assisted living or retirement home expenses. May be eligible to claim the non-refundable medical expense tax credit on your income tax return. I don't need a show of hands, but quite often many individuals were doing their own tax returns or getting a family friend to do it. When we get into these situations, it becomes a little bit more complex than just trying to bang out a few slips yourself. I would use a licensed tax professional, and I would definitely be speaking to a licensed financial planner about the advice on which is best for you. Must be approved by CRA for the disability tax credit, or certificate for medical practitioners required to claim these. And reporting on the tax return will depend on who has paid the attendant care fees. Okay? So it becomes a little bit more complex. Whether to claim the nursing home fees. There's some options. Claim total nursing home fees as a medical expense, but not the disability tax credit. Remember I said earlier it's about $8,400 presently. Claim disability tax credit, but not the nursing home fees. And if you've experienced what the cost of nursing home fees are, I see some smiles out there. They can become quite expensive. I've experienced that as well. Claim the disability tax credit and a portion of the eligible salaries, wages, are up to $10,000. Okay? Requires additional info from the nursing home. So again, a lot of information that comes in there, and some calculations need to be done to make a decision on what would be best in your unique situation. Again, we talk about getting help, and there's lots of opportunities and areas out there that, again, you can go out and ask for help. More information is available from CRA. Tax rules can be confusing. Don't be afraid to seek professional tax advice. The Canadian Caregiver Tax Credit. It's a new tax credit. It came out in 2017. It's in effect for later years. The Canada Caregiver Tax Credit replaces a number of tax credits previously available. Caregivers are eligible who provide support to a dependent who has a physical or mental impairment. No requirements for caregiver to live with the dependent. And everyone in here, I can assume, reads and can read that well. It's a very vague statement, okay? So again, what I would use is I would want to talk to a tax professional or a licensed CFP financial planner who will then be able to sit down and help you navigate these waters to see what's best for you on your tax return. How do you receive this? It's claimed on the caregiver's income tax return. Depending on the relationship between the caregiver and the dependent, there are a number of different ways to claim the credit. The dependent's income decreases the credit and may fully eliminate the credit at higher levels. Okay? So in that situation, what we take a look at is what type of revenue or income is being brought in on the tax return, and is there ways that we can adjust it to ensure that you're getting all the credits that you have available to you. Once again, professional advice may be helpful.
Alzheimer's is something that's very near and dear to my heart. Actually, I had two grandparents that went through it. And ironically now, I'm in the financial services industry alongside Tim. And you know, we take care of just over 20,000 clients in the London and Greater London area. And you know, this is something that we deal with all the time. So, you know, Tim talked about having a financial plan and having a roadmap. And it's kind of like a GPS. So how do you get from point A to point B? And when we talk about financial planning, oftentimes a lot of people just think about the planned events in life. And so for the last half of the presentation, I'm going to speak to you a little bit about the unplanned events in life. So when you think about some unplanned events in life, obviously there's losing a loved one, there's cancer, there's stroke, there's heart attack. But I'm going to touch a bit on memory loss. And how that affects individuals and what the impact is, and some strategies that we can put in place so that we can utilize to take advantage of these. You know, we've worked hard our entire lives, and we've built up this nest egg of assets, hopefully. And so the plan is you want to enjoy the fruits of your labor. You know, you want to live, you want to be financially confident, and at the same time you want to ensure that your money is going to the people that you care, the people that you love, or the charities and organizations that you care and you love as well. So when it comes to decision-making capacity, often what happens is it's very, very rare that we have a client where one day they're able to solve complex issues and the next day they're not able to, unless something catastrophic happens or they get into an accident. You know, people's decision makings or limited decision making ability is impacted over a long period of time. And generally what happens here is, you know, a lot of the clients or individuals, they don't realize it's happening. And a lot of times as well, it's difficult for people to admit that they can no longer remember what they used to, that their memory is not what it's used to. And sometimes they're embarrassed and sometimes they're scared. And you know, individuals like Tim and I are, you know, we're here, and all of our planners, just to say it's okay, and we understand, and we're very, very comfortable, and we're the ones that are here to help you address these situations and to assist you with this. So if this is something that you're experiencing, or that you know of individuals that are experiencing it, please you know, reach out to your doctor, reach out to trusted family members, or reach out to your financial planner as well. I'm going to spend a little bit of time talking about a power of attorney or powers of attorney. And a power of attorney is a document where we call the donor, gives an individual authority, where we call the attorney, to act on your behalf for when you are no longer able to make decisions on your own. And so this is a legal document, and it does not limit your ability to make any decisions as long as you have decision-making capacity. So something that's important to notice here is any lawyer can write up a power of attorney document, but you want to see someone who specializes in this. And so that would be what we call an estate lawyer. And that's a big difference and something to be aware of as well. So what happens if we don't have a power of attorney? This can be a very, very stressful situation, because often what happens is when there's a crisis, if someone does not have a power of attorney, it could be the spouse or it could be the next of kin, they have to go to the court to get authority to act on the behalf. And so while this crisis is going on, now you're dealing with the court. It can be very time consuming and it can be very stressful. And so what ends up happening is the second you do that, you give up your power, because the court can elect whoever they want to act on this individual's behalf. And what happens in these instances is a lot of times the spouse thinks that he or she can just automatically start making decisions on their spouse's behalf, and that's not always the case either. To avoid all this, it's best to be proactive and appoint a power of attorney. So confirm with your lawyer that the document is enduring. This is a clause in the letter of the law where when you have a standard power of attorney, what ends up happening is when an individual becomes incapable of making any decisions whatsoever, at that point in time, the power of attorney is no longer valid. Unless you have a power of attorney that states it's enduring in there. And so we recommend, and it's very, very rare not to have this, to ensure that there's a clause in your power of attorney that states it's an enduring power of attorney, which means that individual has the authority to make decisions at all points in time, and especially when things get very, very difficult. Something to be aware of as well is, power of attorneys are revocable. So a lot of times, people don't want to elect a power of attorney because they think that they're giving up decision-making abilities, when that's not the case whatsoever. They think it's being subtracted. This is an addition. This is something that we put in place for the just in case and to prepare. I have a power of attorney. And I hope my power of attorney will never have to act on my behalf. But I've educated my power of attorney on when this individual should act and the signs to look for on when they should act as well. So it's very, very important to understand this. It would seem like it's common sense, but first and foremost, we want to make sure that the power of attorney that you elect is a very trustworthy individual. We have a bias to elect powers of attorney that are family, because we feel obligated to because of their family. And what ends up happening is when things get very, very difficult, Tim and I have been in instances, we've seen what happens when things get difficult and families get torn apart because of this. So you need to pick someone who's very trustworthy. You need to elect someone that's organized, and ideally, you need to elect someone that is financially competent, they're doing well on their own, and they're capable of dealing with finances. They understand, they have a decent grip of financial literacy, so it's not new to them. And so that makes educating these individuals a lot easier. Of course, if you do not have a close family member or someone who may be an appropriate choice, you can also look into, there's a lot of trustee companies and there's third-party companies that you can hire on your behalf to act as power of attorney. Yes, it does cost money, but at the end of the day, it can save you a lot of money over the long run because they will act according to the letter of the law. So financial abuse by someone as acting as a power of attorney, through coffee shop talks or breakfasts, there's so much news that's going out there. Sometimes people are scared to elect powers of attorney because they think the power will be abused. And certainly it has happened in the past, but again, it comes down to electing someone that's very, very trustworthy and speaking to your attorney in advance, educating them, ensuring that your power of attorney is well acquainted with your financial planner, introducing the power of attorney to the financial planner to educate them on your behalf on what's entailed and what's not entailed. So responsibilities of the attorney, there's a lot more that goes into it than individuals realize. The powers of attorney, they have to document every single dollar that comes in and every single dollar that goes out. And they also have to be able to prove, if ever questioned, that the money that they have spent is in that donor's best interest. And that's very, very important. Yeah, so they can't transfer assets in their own name. Very important to understand that. And they're designed to act in your best interest. So, sometimes what we have seen in the past is a power of attorney will maybe try to access some money or some funds earlier than they should, and their rationale is, well, when this individual passes away, I'm going to get the money anyway, so why don't I just take a bit of it now? And they try to rationalize and justify it that way, but you can't do that as a power of attorney. So joint ownership, We see this a lot. Should I add my children as joint owners of my assets? This is very, very common. Generally speaking, the answer is no. Generally speaking. I see a couple of smiles and a couple of nods here. Oftentimes when we try to ask the question as to, what's your rationale or what's the motivation behind doing this? What we end up hearing is, well, I want someone to be able to make decisions on my behalf and have access to certain things if I'm no longer able to do that. Well, if that's the case, then why don't you just hire a
Power of attorney.
power of attorney, right? So why give up control of your assets sooner than you have to? We've seen this recently happened in British Columbia. So the mother added the son onto her home. They were joint owners. The son owned a business. The business went bankrupt. The creditors went after the son, and guess what they took? Half the value of the mother's home that the mother put the son on. And that suddenly became very problematic. So we recommend using a power of attorney and do not add anyone on joint. Sometimes it works out. We've seen it not work out more often than it does work out. Okay, so adding children as joint owners. Problems arise also at the time of death, okay, in terms of who gets what account and in terms of taxation. And so what happens if you have someone as a joint owner on an account to avoid probate? And then let's say you have a will, and then you have a whole bunch of assets that go through your will, which goes through your estate. And your will states that your children are to receive 50, 50, 50, 50%, 50%, or 25, 25, 20, 25, 25. Well, does that include that account that they're joined on? Does it not include? Did we account for that? So many issues and challenges happen because of this, because it was not accounted for. The simplest answer is just to not add anyone on as joint. I know a lot of people try to do it, and they try to do it to avoid probate. But the reality is that the cost of probate is very, very minimal compared to the pain and the cost that's associated with families suing one another, family members, and hiring lawyers, and the stress and the ruins that come from it. So, probate is a process that ensures the equal and proper division of assets, and that goes through your will. And so we always recommend that things go through probate, and that you have a will in place, and that your will is updated, and you have the right executors, and of course you have the right power of attorney as well. So should I transfer my assets or just give my assets away to my children or family members? What do we think the answer is here? No. No. This would be even worse than adding them on as joint. When it comes to gifting the money away, if you have a financial plan in place, okay, and you've laid out all of the retirement income, and you've stress tested it, after tax, net of inflation, you've planned for the planned events, you've planned for the unplanned events, and you still have this extra pool of money, and you want to give some away, or all of that pool of money away, absolutely. That is completely okay. But what we see more than not is people tend to act irrationally and will give more money away than they plan for. They'll live longer, or suddenly they didn't plan for health care, where living in a nursing home or retirement home can cost up to $55,000 a year. And so what ends up happening is people are outliving their money, and the money is not outliving them. And so if you have a plan in place where you know that the money is going to outlive you, by all means, feel free to gift it away. But what happens is as soon as you give up those assets, we've totally lost control, and we can't get it back. Right?
Life estates.
That's different, right? And that's okay too. Don't take drastic measures without speaking to an advisor. Nursing costs are often based off CPP and OAS, not necessarily the amount of assets that you have or that you don't have. And what happens too is, a lot of times depending on the type of investment that you have or the type of property that you have, if you have a non-registered investment, right, there could be capital gains or capital losses associated. Most times you'd hope there'd be capital gains. And what often happens is when you trigger those, it can create OAS clawback, and that's something that we don't want. So financial abuse, very, very important. And it's, a lot of individuals do not realize that this is happening to them because they are questioning their ability to rationalize what's going on. They are questioning their memory, and they are questioning whether things are really happening or not. And oftentimes this happens between families, and because we love our family members, for the most part, we'd like to think, this individual or this power of attorney is not taking advantage. And so what's important here is if you feel that you are being taken advantage of, or something is wrong, or something is off, it's very, very important to reach out to a trusted family member or a financial planner. Please do reach out. Financial abuse. This is something that's more prevalent nowadays than it's ever been before. I don't know about you, but I get a phone call probably 2 or 3 times a week. They're all different, right? I see a lot of nods. People claiming that they're with the police, people claiming that they're with CRA, people claiming that if I don't call back right away and provide financial information, the police will arrive at my door and I'll end up in jail. And then the latest one is people who are impersonating bank representatives from your bank, claiming that you need to call back and provide all that information. And so, there's a lot out there. And then, there's the common ones. So, there's romance scams, and then there's, criminals asking to receive money more than they give money back. So very important to be aware of that, and especially with the bank one. If it were me, I'd probably walk into the bank and try to have a conversation with someone there before I make a decision over the telephone. So where to find information? With respect to pensions and CPP and OAS, we recommend going to the Service Canada website. A lot of times you can call them as well, and if you're interested in finding out how CPP or OAS works, you can always call and ask for your statement of contributions receipt. Okay. In terms of income taxes, CRA, I know they're not the most friendly. Sometimes it can be challenging getting a hold of them, but that would be our #1 recommendation or source to go to. And then financial watchdogs. So in terms of all the scams and everything that's out there, these are just a couple of different companies or associations that you can visit, and they can educate you on all the scams that are out there, what's most prevalent, tips to look for, and traps to avoid as well. With respect to evaluating professionals, of course, use the right professional for the right job. Ask about their expertise, ask about their experience. So if it's a financial planner, ideally, you want to work with someone or know someone who has their CFP, Certified Financial Planning designation. If it's a lawyer, again, you want it to be an estate lawyer or a trust and estate lawyer, a TEP. And if it's an accountant, you want them to be a CPA. So, in the industry, this is as high as you can go in terms of education within all these respective fields. Thank you so much. It's been an absolute pleasure, and we hope that you gain some value from this presentation.